What's up, everyone? Hope you're having a good weekend so far. We're going to go over the second part in this Ascension video, part 2, and this is going to be using the new commands that we just implemented to capture some of these profits from the option anomalies that we've been seeing in the markets. Now, the way we're going to do this, I'm going to go through all the new commands and explain them all. And again, this wouldn't be possible without the members or the membership in general. So this is what it's all about, improving our capabilities. So the commands we have to use, I'm leaving out the IV rate for now. I will talk about that one later, separately, later on when I get the additional IV mean or IV average command put in. But for now, we have IV calls / IV puts / HV Parkinson, which is the historic volatility. Be sure not to get this one confused because historic volatility is not the same as implied volatility. Then we have / earnings crush / IV percentile / liquidity / option _ price, and then / smile. We're going to go through these real quick. And this is legit data. This is from NASDAQ Data Link and Quant as well, who works very closely with NASDAQ Data Link. And using IV calls, the implied volatility for at the money should be the lowest, but what we've observed in the market as of recently is the fact that IV is lowest out of the money, which is unusual for calls or puts. So this model and their whole entire data set is theoretically optimized for our option smiles, since it's normally optimized for at the money calls with the lowest IV, which happen to be the smiles. Now keep in mind, again, this data is from NASDAQ Data Link and is optimized for at the money strikes with the lowest IV. Since we know the lowest IV are out of the money right now, that means these data sets are optimized around our smiles. Now this is what the output looks like in Discord. I'm going to make it ephemeral so that only the user of the command can see it so we don't clog up chat. But basically you're going to get the explanation for what it is, and then the buttons underneath it are going to have the actual values. Now it's telling you that for the 10-day IV, the value is 77.7%, 78.9%, 85.5%, 83% for the 60, 90-day for the 78.4%. This is basically saving you time from going to look through your options chain. Same with the put side. It's the exact same as IV calls, except you're looking at puts now. Implied volatility for the at-the-money puts, or in this case, smiles, since the market conditions are changing. And it's measuring against the expiration dates that you can see in the options chain. So this one's pretty basic to understand, not too complicated with the put IV, call IV. HV Parkinson's is a different kind of IV that is calculated using the high and low prices of the stock on each trading day for a calendar period leading up to the most recent trading close. And you have a little legend here. So 10 calendar days is going to be 7 trading days. 20 calendar days is going to be 14, and so on and so forth. This is basically giving you a PHV percentage of the high and low for each day for the 10, 20, 30, 60, 90, 120, and 180. This is probably the one you will be using the least amount. I may even remove this one. Now this one here is pretty important. This is a new one, earnings crush. Now this is the expected crush rate for the at the money IV. Now keep in mind, at the money IV is not the lowest, so this is theoretically speaking about our option smiles. And it's the crush rate for the smiles of the expiration immediately following the next earnings announcement. So what is earnings crush rate? Well, the most common source of uncertainty for stocks is the earnings announcement. Given the impact these announcements have on the value of a stock and its options, many investors are drawn in for the potential to profit using a variety of option-centric strategies. As a result, IV typically peaks in the days leading into the announcement, meaning you should be holding options on those days leading into the announcement, because when IV rises, likely you're going to be profiting. Now, as a result, again, IV peaks in the days leading into the announcement and returns to normal, so to speak, after the information has been disclosed publicly. This rapid drop in IV following the earnings announcement is often referred to as the earnings crush. Earnings crush does not happen before earnings. Sometimes it does, but not always, obviously. Most of the time, earnings crush occurs after earnings, hence the term earnings crush. Whether taking a long or short position on these options, investors need to understand the impact that these earnings crush have on their options. And the way this model works, it uses a proprietary method, and the crush rate estimation provides an effective measurement for how the market is pricing the post-earnings IV crush. Now, the rate is simple to use. It is provided as a percentage and optimized for at-the-money, or in our case, SMILE options expiring on the first post-earnings expiration date. For example, a rate of 0.70 implies that those options are expected to see an IV drop to 70% of their current value, or a 70% rate, or a 0.70 rate, equals a 30% drop in IV after earnings. A 0.9% rate, or 90% rate, equals a 10% drop in IV after earnings. A rate of 1.2 implies that the IV of those options are expected to rise to 120% of their current value. And this can happen when an earnings announcement is far off. So if you see a return with a high rate of 1 or higher, maybe a good time to buy that one, as it will likely decrease up leading up to earnings. So a rate of 1.2 doesn't mean 120% gain. It means a 20% increase in IV after the earnings. A 1.9 rate is a 90% increase from the current value in IV after earnings. So I know it's a little counterintuitive. So a rate of 0.4 equals a drop of 60%. A rate of 0.1 equals a drop of 90%. So the higher the rate leading up to 1, the more of its value it will retain post-earnings. Now, given the nature of implied volatility relative to the earnings announcement date, the crush rate can be expected to be more accurate as the date approaches and when used for options closer to the money and closer to the expiration following earnings. In addition to the crush rate, this data set also includes the number of calendar and trading days until the stock's next earning announcement. These fields are extremely useful in screening potential candidates. Now, this is what the output looks like. This is an example for AMC, who just had earnings, and it has a 79.42 crush rate. So as we just read, this is going to be more accurate as we get closer to earnings. And considering AMC's earnings are 64 trading days away, this would mean this is likely to change leading up to their earnings, meaning you should probably hop on the options now while the IV is in the lower side. This is a Walmart earnings crush rating. The crush rate is, oh, I messed that up. That should be 0.73, my bad. 1 second. Walmart crush rate should be 0.74 or 74%, which is, oh no, I was right, my bad. It's a 26% drop. Yeah, my bad. I psyched myself out there. So yeah, if the rate is 0.74 crush rate, that means GME is going to retain 26% of the value of its IV post earnings, which is 5 trading days. Oh, I'm sorry, this is Walmart. Walmart 5 trading days away. My bad. So Walmart 0.74 crush rate equals a 26% value retention in IV after earnings. Now this is close. This is a close earnings. So however, this is still pretty high up there, meaning we may not see much crush after Walmart earnings. Does that mean we should hold past earnings? Definitely not, because it's still going to lose some value after earnings. We always want to hold up to earnings, let it go, and then play the recovery after earnings. Now let's look at an example of a positive crush rate. So this is GameStop. Their next earnings report is 26 days away. They have a rate of 109, which means that GME will retain or gain 9% of its earnings, of its IV after earnings. So let me read that through that again. GameStop, 109.47 is the crush rate. That means after earnings, it will gain 9% of the IV after earnings. That's basically all it is. If it's over 100, it's going to be gaining percentages. And it's easier to calculate over 100 because if you see 109%, it's going to be a 9% gain. If you see a 150% crush rate, that's going to be a 50% gain in IV from the current value. And it's always measuring against the current value. Okay, next we have IV percentile. This is also a very important one. Another method for rating the current IV is to rank it relative to all IV measurements over the historical term. So this is where we're combining IV and HV a little bit. Now, for example, if half of the past year's measurements of IV have been lower than the current IV, then the current IV percentile would be 50%. If only 20% of the measurements were below the current IV, then the IV percentile would be 20%. This approach effectively accounts for the density of historical measurements. So, looking at this command here, and these are updated daily, by the way, the IV30, only 24.5% of measurements were below the current IV. For the last 60 days, only 26.1% of measurements were below the current IV. For the last 90 days, only 26.1% of measurements were below the current IV. And then for the last 360 days, 67.86% of measurements were below the current IV. So these are the ones to look at here for your IV. This one here, more measurements were higher than lower. Liquidity is a pretty good one. Also, it's going to rank your ticker symbol 1 through 5 based on their liquidity score. A score of 1 is none, all other optionable stocks. A rating of 2 is the next 20-30% of stocks with some lightly traded options available with wide bid-ask spreads. 3 is fair, the next 5% to 10% of stocks with some lightly traded options with moderate bid-ask spreads. Number 4 is good, the next 1 to 2% of stocks with many options that are moderately traded and have moderate bid-ask spreads. And then the best rating is 5, which is the top 1 to 2% of stocks with many options that are highly traded and have tight bid-ask spreads like SPY, QQQ, and other high-stake ETFs. Next, we have option price, and this is how you put the command in for slash. You have to put the symbol twice, the expirations in year, month, day format with no dashes, so it would just be 220812 for the 12th expiry, for example. The strike price you have to do with 3 digits. So if you want a strike price of 20, it has to be 020, not just 20. You have to throw in that extra 0 at the beginning. Then once you got all that in, push the command through, and this is your output. It's going to give you your closing, your high, your low, your open, your previous close, your volume, your open interest, and your VWAP price for this particular strike that you put in. Okay, and this is one of the best ones, the smile command. And basically, implied volatilities for the same expiration period vary across the different strike prices. In general, the shape of the graph of implied volatilities against strikes takes the form of a skew or a smile, where the implied volatilities are highest for the lowest strike prices and slope downward to reach a low near the money. Then, depending on market sentiment, the implied volatilities may slope further up, down, or even stay flat. A call smile, when the skew slopes upward after the at-the-money strike, the IV becomes lower. In other words, the IV becomes lower as strike prices increase, may be a bullish signal. If the IV gets lower as the strike prices decrease, it may indicate a bearish sentiment. And then here's an example chart for what a skew looks like. This will not change with every ticker. This is just a generic example. So a put smile is with the lowest IV out of the money sloping down in the options chain, like what we see here with GameStop for next week. A call smile with the lowest IV out of the money sloping up in the options chain is what we see here with Walmart. This is the output of the command. I'm going to have to fix the date there. My bad. I will get that fixed. It'll say the current date that it's measuring. But how you can measure these dates and smiles against the expiration is if you look in your options chain, it gives you the number of days right here until the expiration comes. Just match it up with what you want to measure here in the different buttons, and that would be a good way to cross-check that. So basically what this is telling you is that for GameStop, the 10-day smile has the biggest skew down the options chain on the put side because it's negative, and then you see it gradually gets smaller and smaller as we go out further in time. Now all commands reiterate these explanations inside the command embeds themselves. So let's go make some fucking money. We have the commands to do it. We have the understanding to do it. And I'll get an explanation out on a couple more of the commands I have coming out later. And basically, like this right here, if it's negative 20%, you want to look for the smallest number for the best put side play and the largest number for the best call side play. So for a call side example, you would see positive numbers here in the percentages, and you want to look for the biggest one to get the biggest skew to play off of. But that's basically it. And I will be purchasing the real-time data for the option price command, this one here. So that way this will update intraday each time we call the commands. So hope this helps.